And of course, on dollar moves, Simon Michell from FIIG live for you at the camera there in Sydney. Simon, I mean, in terms of the pace of this next wave of Fed tightening, any meat on the bones this week, you suspect, or it's too soon to chart that course, and it will be more still an explainer of the action from last week? How do you sum it all up?
G'day, Carson. Look, I think that's the key point at the moment. We do hear from 10 Fed officials this week, including Janet Yellen. And I think it will be about explaining why we didn't see any adjustment to those future projected forecasts of further rate increases. We saw the increase. We didn't see any building in of higher growth forecasts in the future, and that really goes against what we've been seeing, apart from today, in the equity markets. So, you know, I think you're absolutely right. I think people are starting to wonder what's happening there, why we're not seeing that sort of growth inflation forecast start to be reflected in long-term rates. And you've had just overnight long-term yields, the 30-year rate back down to 3.03%, about 20 basis points below where we've seen the peak this year. Which
is counterintuitive on every level, is it not? And understanding it, what does it come down to? How do you put that into your frame of reference?
Well, look, I think what we do when we look at long-term rates is we see, you know, around the 10 years, really a bit of a proxy for growth and inflation. It really gives us a bit of an idea of what the market is building in over a long period of time. Now, you've had the equity markets. They've been very much running off the back of, you know, policy expectations through the US of significant infrastructure spending, that would flow through to higher growth. You know, the Dodd-Frank laws, you know, providing more growth in the banking sector as well. We're starting to see a little bit of that unwind. And, you know, we've spoken over the last couple of weeks how the bond market just wasn't buying into the same irrational exuberance. And we're now seeing the equity market come back. And we're just not seeing any movement in those long-term rates. So that means that the debt market, the bond market, is not convinced on these higher growth forecasts that you have seen commentators use.
How does it square with the banks saying that they are facing in an offshore sense, elevated funding costs? Now, when you're talking of that static story, is that aligning with the bank's commentary?
Well, I think you've got two things there as well. I mean, you know, if you have a look beyond the US, you know, you're certainly seeing some higher levels come through and some support being pulled back as well, and that is certainly impacting. There's been a lot of issuance as well, so investors are demanding a little bit of a higher return for that. You know, we are sort of getting, you know, to the point where, you know, we only have 4 major banks. So, you know, your exposure to that does reach a limit at some point. You know, we've seen a lot of refunding. We've seen a lot of bond buybacks, refinancing. You know, at some point, you know, the market does sort of pull back, you know, a lot in sovereign as well. Here in Australia, for example, a lot of government debt issuance. We've seen the demand start to pull back as those volumes have increased. On top of that, you've got China selling out of its treasuries as well. So you've got a lot of global movements of cash being influenced by movements in rates.
On the China story, you know, you're highlighting and you're pulling out some under the bonnet concerns about small lenders in the interbank market. And does that snowball? Does that actually have the potential to become a, you know, from something peripheral to something core concern?
Look, it's something we've known about for a while, and we know that the Chinese government and central bank has been pulling money and using that to throw into its financial markets and support liquidity. We know that as part of the maturing of the debt markets in China, they want people to experience default. They don't want to jump in and support all of these lenders when they get into problems. You know, you know, learning that there is a default mechanism is part of the development of the bond market. So I don't think at this point, Carson, I think, you know, we've seen an increase in short-term lending rates, money market rates. That reflected tightening liquidity. So where these lenders aren't able to pay their loans back, the government is throwing some money into the system to provide some credit availability. I think it's certainly something we're watching. But I don't think at this point we think it's going to lead to, you know, beyond expectation.
Because you say, I mean, on the one hand, you know, they've got to learn from their mistakes. Let the market be the market. On the other hand, if they're putting some money their way, it's kind of, you know, it's a mixed message. It's a mixed commitment to the market. You're either with us or you're not with us.
Well, this is true. I think what you're seeing is, you know, the investor is learning that, you know, you have to take care and there are going to be defaults, and that is something you have to be aware of, and that the central bank is not going to step in and support those smaller lenders. However, they will support the institutional system to ensure that there is liquidity in there to compensate for these defaults, essentially.
Okay, let's go into Aussie issuance because some interesting auto developments as much as on the resi front. So let's look at the Hyundai connection first off, shall we?
Yeah, Hyundai. So they're looking to do a kangaroo bond. So this is Hyundai Capital out of South Korea coming to Australia, issuing an Australian bond in Aussie dollars. We've seen a lot of that happen recently as investors diversify their exposure to global markets. I've also heard this morning that AMP are looking, going around having a bit of a chat to some of the banks about an issue. But as you mentioned there, Carson, also just in the last week, quite a lot of residential mortgage-backed security issuance. So this is an ability for the banks to remove mortgages from their balance sheet and sell them as individual bond assets. And we've seen a lot of issuance in that space right across a range of issuers recently, and no surprise given where the housing market is.
And just briefly as well, you touch on the South Korean connection, all the political instability of late, has that fed through into money markets in terms of the funding? And do you sense that that could be an added spur to have come down under if there's been a domestic tightening of conditions even? I mean, what's been the prevailing attitude through that crisis of domestic lenders?
Look, absolutely. Look, a very interesting point. I must admit I'm not across South Korean rates, unfortunately, so I can't contribute to that conversation. But I think what you are seeing is you're seeing both a maturing of the Australian debt market, so there is strong demand here. And that's been reflected by our domestic issuers being able to get a lot of debt away. And, you know, we don't have a very mature debt market in Australia. Our allocation to direct bonds is very, very low. So there's a huge amount of upside there. But I think at the end of the day, you know, the US market, European market, you know, generally they'll be fairly swamped there. And it is about, you know, diversifying through different sovereign tax you know, areas as well. Just to diversify where part of your business is. And we saw this with Apple a couple of years ago coming into lend as well. So it sort of just matches where their business flows as well.
Indeed, follow the money. Talk to you soon, Simon. Follow the business. Simon Michell there from FIIG. Do stay with us. Follow